The stock market has been interesting to say the least. We've had wild swings between doom and gloom, and let's get it on. And the big question on everyone's lips, has the market bottomed?
Bottom.
Today I'm going to look at the stock market and consider what will it do in 2023. Sorry, couldn't rhyme it. I'm Biko Konstantinos, and that's what we're going to talk about today. If you've ever been given a candle as a present, why don't you like this video? And if you want to make that subscribe button feel a little less lonely, why don't you just give it a little click? We all need someone to click on our buttons every now and then. Now let's see if we can pinpoint to 100% accuracy what the market's gonna do. Of course that's impossible, but it's always important to listen to different views and then come to your own conclusions, but be open and flexible to be able to change those views as incoming data comes in. Let's check out the Dow Jones index. In January 2022, the Dow Jones hit an all-time high around 37,000. Since then, it's trended lower, but we've seen some very big swings. So we saw a swing here from about 30,000 all the way up to 34,000. And just recently, we've seen a swing from 29,000 all the way up to nearly 33,000. Now check out the last 4 weeks of trading. We had 2 weeks of indecision, but the last 2 trading weeks have seen massive gains. Does this mean the stock market bears over? The good times are back. If we draw a trend line across all the highs, we've still got a downsloping trend line that hasn't been broken. If we saw a break above this trend line, short retracement, and then a rally to new highs above this previous high, then that could signal the end of the downtrend. So what is the Dow Jones? Well, the Dow Jones Industrial Average is an index of 30 US blue chip large capitalized companies, which has become famous as a gauge for the US stock market. However, because it's only a representation of 30 companies, which means out of the 30 stocks, those with the highest stock price affect the index greater, it doesn't always present an accurate reflection of the broader stock market. The 30 companies are chosen by a committee and balanced to try to represent the overall economy. Let's see the current list of stocks making up the Dow Jones Industrial Average. We've got some very big names like Apple, Coca-Cola Company, Home Depot, Johnson & Johnson, McDonald's, Microsoft, Nike, Walmart, and Walt Disney. So plenty of very well-known names in that list, but some of the higher priced stocks could be causing a greater impact on this index. If we look here on our list of prices, United Health Group has a stock price of 551, which is miles ahead of the others. And if we bring up the chart for United Health, the stock's been performing brilliantly and is on the brink of making new all-time highs. So because stocks like this will be having a greater effect on the Dow Jones Industrial Average, personally, I don't find it a good representation of the entire market. For me, the best gauge of the overall market is the Standard & Poor's 500 index, also known as the S&P 500. This is a market capitalization weighted index of 500 leading publicly traded companies in the US. In general, the S&P 500 measures the 500 biggest companies predominantly by market capitalization in the US. As a result, it's regarded as one of the best gauges of the stock market overall, because if the 500 biggest companies in the US are doing well overall, then the stock market is doing well. But if they're not doing well overall, then that would be a negative for the stock market. So the S&P 500 is in a clear downtrend, but unlike the Dow Jones, which is testing the downtrend line, the S&P still has a long way to go and will need a clear break above this downtrend line, perhaps a small retracement, and then a rally that takes it above this previous high here before we could assume that the downtrend is over. So yes, the biggest 500 companies in general have had a small rally, but overall they're still firmly in a downtrend. The NASDAQ, which is made up of around 100 of the largest non-financial stocks, is looking even worse. Now the NASDAQ is best known for its large inclusion of technology stocks. And if we look at the biggest companies on the NASDAQ, we can see some huge tech stocks like Apple, Microsoft, Amazon, Tesla, Google, and Meta, which used to be Facebook. Now all these tech stocks did wonderfully when the money printer was flowing. But look what happens when you turn off the money printer and increase interest rates. One of the biggest falls from grace is Facebook/Meta. From a high of nearly 400, the share price has now collapsed to under 100. When you see this happening over previous market leaders, you know that something is amiss.
Something's wrong, something's amiss.
So the NASDAQ to me gives us one of the best pictures of a bubble scenario scenario, which has now been busted. We had a similar situation in the dot-com boom here, and time will tell if things end up as bad as that. Now, the US stock market is extremely important because it's the biggest economy in the world. As a percentage of the global economy, it makes up about 24%. Now, the second biggest economy is China, making up about 18.5% of the global economy. So if we consider the Chinese stock market, represented here by the Shanghai Composite Index, we can see some spike periods over the past 15 years. But with the index sitting now at about 3,000, it's a long way off these previous highs and frankly looking pretty lackluster. So in the last year, the difference with China is that it didn't see that huge bubble in 2021. So subsequently, it hasn't fallen as much either. So the current picture of the two biggest stock markets is a picture of weakness. But will that weakness continue into 2023, or is the pain now behind us? Now, what was the biggest economic story in 2022? No, it wasn't Kanye losing his contract with Adidas. I am a god. It was inflation, baby. You can see from these graphs a global inflation crisis. Because if inflation rises to 7 or maybe 10%, you have to get it under control or it can start to run away, and that has the potential to destroy entire economies. So many countries around the world have the highest inflation they've seen for 40 years. Now, the real big kicker has been rising interest rates to try and tame this inflation. As you can see from this long-term chart of US interest rates, they were actually declining since 1985 to fall all the way to zero after COVID. Now, since COVID, it's risen sharply to nearly 4%, with mortgage rates more than doubling in a very short period. However, the biggest concern for me is that these declining interest rates for multiple decades put a rocket under assets like real estate and the stock market. And the fact that rates are still low compared to their historical averages makes me very concerned that these artificially inflated assets could get officially smashed. Rising interest rates can crash the stock market for the following reason. Interest expenses eat into company profits. In this Starbucks example, if a company had to refinance their interest rates at a higher level, their interest payments could end up doubling. And that means much higher expenses and much lower profits. As the cost of debt increases, consumption decreases. Basically, consumers are paying more interest, so they have less money to purchase things, which means that companies are not able to sell as many products because less consumers are buying them. And when companies sell less, their profits are reduced. And thirdly, asset values decline as interest rates rise. That's because when companies on the stock market are valued, they're valued on future performance. And if that future performance is affected by higher interest rates, then that stock or entire stock market is valued lower. Now, you might sit back and hug your Darth Vader plush toy and think to yourself, big deal. Interest rates have risen and the stock market's doing just fine. Check out the Dow Jones, which has risen about 2,000 in just 4 weeks. But I would say to you that interest rate hikes has a lagging impact. So they've been hiked very quickly, but they might take 3 to 6 months for those rate rises to really have an effect in the market. That impact will really hit hard in 2023 as companies pay more and consumers spend less. Another big factor to consider is the unemployment levels. Unemployment rates are artificially low at the moment because of rates being dropped to near zero for so long. But because of that lagging impact of the interest rate hikes, as companies start to feel the pinch, layoffs will start accelerating, which means unemployment levels will start to rise. I think we'll start seeing this occur in 2023, and the effects will be massive. At the moment, spending is being reduced because of high inflation and higher interest rates, but if unemployment levels were to rise quite significantly, spending levels could really drop, and that will have a massive impact on companies and the broader stock market. Amazon just recently fell 20% due to disappointing quarterly earnings. Now imagine what will happen to companies like that if unemployment was much higher and consumer spending much lower than it is now. So my thoughts on the stock market for 2023, I can see this bear market or downtrend continuing all the way through 2023. And I'll retain that position as long as the downtrend remains intact. And for that, I'll be looking for lower highs and lower lows to continue. But if the price data changes and we start seeing higher highs and higher lows, that's when I'll change my position. In the stock market, the trend is your friend. I'm Vico Konstantinos.